Winston Churchill once said, "The further back you can look, the further forward you will see." Today, I'll bring you on a journey to explore the previous bear markets that has happened. And right now, we've actually just crossed into the bear market territory for S&P 500. Corrections are plentiful, but bear markets, they're actually not that common. They happen maybe once every 7 to 10 years. Now, today I'll be explaining the significance of crossing into the bear market, and hopefully it scares you enough so that you become a bit more immune to some of the bad news that might come on for the next few months ahead. So if you're keen, continue watching on. Hi guys, welcome back. Let's look at some comments by bearish investors. Two of them, Jeremy Grantham and Michael Burry. They both warn of another market plunge. Whether that is true or that is going to happen or not, nobody knows for sure. And towards the end of this video, I'll be actually sharing a small clip that's been mentioned by Jeremy Grantham so that hopefully it gives you further food for thought where to allocate towards, especially if we move forward in this bear market. So let's firstly start off with some of the biggest recessions and bear markets that have happened, and quite obviously the best place to start is 1970s. That was a period termed as the Great Stagflation. Actually, back in 1969, there was already massive unemployment, and stock markets have already been correcting since 1969. If you look at this chart over here, you realize that there was a decline into the bear market, and then another 10 to 15% more of its peak. In total, there was at least another 10 more months worth of pain for investors back then. 1970s was really a period that was very difficult to invest. Inflation was high, unemployment was high. Stock market actually tanked for the entire 1970s itself, as you can see in this chart over here. So while I pointed out the decline from 1969, there's actually another bear market that happened subsequent to this. Now, investors who had survived that 1970 bottom saw a leg up, doubled their monies, but subsequently they had to face yet another big bear market. This is the 1973 bear market. When it crossed the 20% bear market level, it plunged subsequently for a further 30% this time round. From top to bottom for this bear market, it was 50%. Now this bottom seems to be slightly further, but to get back to this level whereby it crossed the bear market, it required another 1.5 years for an investor wade up. Nowadays we are so impatient in getting results. Maybe hearing this tones down your expectation. Maybe this tells you the amount of time you need to wait to see sunshine again. So hopefully it gives you the right mindset and right patience to approach this bear market. And just now I mentioned 1970s was really hard. After surviving this, an investor had to go through another down leg, and that was in the 1977 period. This is actually a period whereby stock prices decline gradually, which is very different. But in any ways, 1 year of slow declines are also very difficult to wait it out. Imagine if you are an investor back then. At high inflation means the bank deposits are probably quite high also. You'll be comparing to if you had just put your money in a bank account, you'll be getting 5 to 10% maybe on the fixed deposits back then. So 1970s was a bad period for investing. And if you look at charts, you realize that 1980s onwards seems to be very good. Simply because if you understand this, after a bad period, there's usually a good period. And after a good period, there's again another bad period. So it's like a spring coil. 1970s was really hard. Then after that, it expanded quite broadly. And it climbed quite rapidly in 1981. But surprisingly, after this big climb, there's another crash to show you. This is the one that peaked in October 1980. The decline from there subsequently was 1.5 years. But the moment it cracked the 20% bear market level, it had a further 7 months more to run down. Then of course it's sunshine again. So let's move forward to 1987. In 1987, this is a peculiar event. This is actually the Black Monday flash crash. Quite a bit like COVID, but it's not driven by COVID. There's no real explanation for things. But I guess this does not relate very much to current situation. So let's move ahead to find the next moment whereby markets actually decline more than 20% and hit a bear market. Surprisingly, we had to fast forward for a further 13 years. To year 2000. And before you get there, help me smash the like button and press on subscribe, especially if you like tutorials, helping you to understand how to invest better. Year 2000, that is of course the dotcom bubble crash.
Bringing it all together with the true power of the internet.
If you see, this is quite possibly the worst, simply because the run-up was also the most aggressive. In March of 2001, markets have actually crossed the 20% level into a bear market territory. And that was the start of big misery for investors. It took a further 1 year, 3 months to reach the absolute bottom. From top to bottom, S&P lost about 50%. And the worst part is, in this period, you'll see multi-rig rallies, which definitely looks like good news to investors that the market has actually bottomed. So moving forward, in this bear market, expect these things to happen. Don't get too depressed that it's not the eventual bottom. And this really illustrates, if you are a trader, it's really hard to go long or go short. And as always, I've suggested, it's fun to pick a direction of the market. I also do that. But the deeper message is you really don't know where markets are going to turn. It's just a 50-50 guess. Do note, S&P 500 has actually weightage in other areas, which includes big oil and many sectors. If you look in terms of Nasdaq, the carnage is even worse. Tech severely underperformed for years to come. And if you track the better performers back then were definitely banking and energy. So let's fast forward another 8 more years to the next bear market. That's quite possibly the most recent one that we have seen that resembles what we might look moving ahead. That was the global financial crisis.
The American financial system is rocked to its foundation as top Wall Street institutions topple under...
If you zoom out, you realize the S&P went up, came down, and went up to a level that was very similar to that of the dotcom bubble crash. So if you invested at a peak, it would have taken you 8 years to get back to that peak. Very painful journey, correct? So investing is not easy, especially if you buy inflated assets. It might look quite awful for quite a long while. So if we zoom into what has happened, you realize that markets actually cracked the bear in July 2008. And Lehman Brothers saga was actually in September, so markets actually foresaw big problems. That is why that big plunge subsequent to that, correct? And you realize from that point onwards, markets actually dipped a further 40%. Top to bottom, S&P 500 lost 55%. Very painful, correct? But I have an interesting finding. If you map this chart together with the dotcom bubble crash, you realize that there could be big drops after this bear market level has been breached. Investor sentiment, in my opinion, tends to get very damaged from then on. But the surprising part is not just this. Back then in 2008, US was not sexy at all. The hottest investment idea was actually BRIC, Brazil, Russia, India, China. 4 big developing economies. And just to put things in perspective, if you thought US equities did bad, China equities did far worse. They declined 70% from top to bottom. So fast forward today, is the most inflated place US or China? Could tables have turned this time round? Think about that, because that is something in line with what Jeremy is suggesting.
In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest.
As you can hear, Jeremy Grantham is extremely bearish on US equities. He's mentioned that US equities are shockingly overpriced, and the last sentence he mentioned, if US had ran up the most, it will likely decline a whole lot more than the rest. That is a viewpoint that I personally agree with, but it also doesn't mean the rest of the world's equity will do well. It's just simply, if that place is more inflated, likelihood they will decline even further. Now the $1 million question again is, have we reached a bottom for this bear market? Everything that I've suggested is to prepare you for worse times ahead. I don't know for sure, but I'd like to draw an inference from VIX index. I kind of see certain resemblance as to right now we're seeing an inflated VIX figure. VIX measures volatility, it measures especially when markets plunge. I would like to draw similarities between this period and this period over here, which is in 2008 before a big dip from Lehman Brothers. If we were to see that leg coming in, that pain could be quite severe. So prepare hard for it mentally. And as always, go a bit slower, go progressively. Don't expect market bottoms to be confirmed that quickly. That is why on this channel, you haven't seen me posting videos. Oh, I'm investing $15,000 a month now to buy this bear market. I also haven't done any videos. If you invest in this bear market right now, the odds of gains are so good moving forward. I haven't done those videos yet. Those will come in probably towards a more mature bear phase where I feel sentiment is really sour. But I'm also preparing for the worst. So a few key rounding points that I would like to re-echo for everybody is listening right now. If you're not savvy with investing, go slow. Go with something like Singapore, which is more in banking, over Nasdaq. I believe Nasdaq could underperform STI, and that has looked correct so far. Moving forward, I also don't know 100%. Next, if you have a DCA, dollar cost averaging, stick with it. Although history suggests big legs down after the 20% mark is breached, We don't know what will happen moving forward also. The best is not to be 100% sure. If you have a plan, stick to it. Acquiring it slowly definitely still works, especially if you are underinvested. Do remember, it's always the darkest before the dawn. Number 3, same as in 1970s, commodities look to do well in a high inflation cycle. Currently, commodities are seeing big corrections also. They have not been insulated. I've also seen declines in my portfolio. For that, I'll be doing a full update pretty soon. If you're keen, smash or subscribe, stay tuned for it. And leave any questions you may have on commodities so that I can pick it up for that tutorial ahead. Again, Mr. Churchill has shared, the further back you can look, the further forward you can see. Hopefully this journey looking back in time gives you more courage moving forward. And I'll see you next tutorial. Take care as always. Goodbye.